I'm Randy Barkley, and this is Jeremiah Lee, and we're with Tricord Advisors, and we're talking about tax today. This week, it's interesting. We're getting towards the end of the year, right? And taxes. Most people think I'm going to do my taxes in April,
Right.
but no, we need to do some tax planning.
Yeah, this is the key moment for tax
Right,
planning.
exactly. Because what happens between now and December 31st, a lot of it you can't go back and redo after January 1, right?
Right. And there's some things that have changed this year that we want to talk about today. There's some things that are just normal levers that every year, November, December, you should think about and see if it's going to help your tax position.
Yeah.
So the first one I think we're going to jump into is an odd one to me. It's new. So people.
Is this because of COVID?
I think so.
Primarily. Yeah.
So when people work in a state and they live in a state, they pay taxes in that state. That's very normal. But there's people for years who have worked in one state and lived in another, and there's tax rules that apply there. But with COVID, they're having people who live in one state, they work out of their house in that state, but they work for a company that has an office where they used to work in a different state.
Yeah.
So where do they pay taxes? Who applies?
Well, there's a rule now called a convenience. I love this convenience rule, right?
Yeah. Convenient for the people,
right?
Yeah, convenient for the IRS, convenient for the company.
But potentially, you could have both states taxing the income that comes from that person's work, and you're thinking, like you and I were talking about this. It's like, really?
Yeah.
But this is a real thing.
Yeah. So the case has come up is Massachusetts and New Hampshire. Residents who work in one state and live in another. And it used to be they would commute back and forth, where now they're I guess the New Hampshire folks, Massachusetts is trying to reach in and tax those folks to say, well, you work for a New Hampshire company, even though they live in Massachusetts. I could have that flipped. We'll have to see what the case, but that's the idea. And it just highlights this new dynamic that people could live in one state and work in that state fully, but we related to a company in a different state, and there's tax rules apply. And the worst is, getting, we're here in California, getting California taxes plus another state taxes.
Well, again, I've had people tell me that they would like to move to Nevada or Arizona and basically keep their business activities in California, and that just becomes problematic.
Yeah,
it could really create a real problem for you. But this kind of deals with this,
right? And
it's because of COVID,
right? And this is something that we don't have advice on. This is something you need to talk to your tax advisor,
right?
Whether some, like, example being, if you pay international taxes, the U.S. gives you a credit for the taxes paid in other countries, so it's not you're actually paying double tax. It's just an offset of what's paid where. State-wise, I assume that's the same, but I don't know. And
in this particular article, it was kind of like, I went, what?
Right.
So I went back and reread it, and I went back and reread it again. I went, that can't be
right.
But in fact, it does happen.
Right. And the issue is that you're not dealing with like federal overlay of how these are supposed to interact. These are just different states. And the state says you owe tax here. And another state says you owe tax here.
Yeah.
And they don't have I have to play nice in the sandbox or some sort of a offsetting rule that's consistent across states. It's simply a state saying, oh, by the way, you owe taxes here.
Right. This is kind of a unique situation. And if you're listening to us, this is something that, if you happen to be working remotely and you live in one state and you're working out of another state, it's something that you want to talk to your accountant about, your CPA, because we can't really give you tax advice, but we would work with your CPA or whatever in the planning process. We're talking with a lot of clients right now about retiring and moving and, or selling a business and things like that could create a huge tax bill. So people are trying to figure out, do they move to another state? This is an odd deal in the sense that's the earned income, the income that you're making. And they talked about in this article about people that are independent contractors. That becomes even more problematic, right? If you're doing the work in one state, but in fact, you're claiming residency in another, I could see where California would come after that.
Oh yeah, California is fairly aggressive in reaching after people, and other states as well. So I think that's a good one to think about, and if that applies to you, make sure you get good tax advice. The other one that's interesting is Biden's student debt forgiveness.
Right.
This one, yeah, you hear about it, and
everybody's free, right?
I'm sure there's some students that say, "Hooray, this is great." So there's been a number of spins and curveballs and concerns with this. One that we want to talk about today is potentially the taxes.
Right.
So the federal government has said there won't be federal taxes on your debt forgiveness. This is a government program. This is okay. But states have not confirmed that. And there's a handful of states that, based on current laws, it appears this would be called forgiveness of debt.
Yeah.
And forgiveness of debt is a well-known item that when you're forgiven a debt, the government treats that as income to you.
Right.
And for this federal forgiveness program, there's a concern that states will say, hey, that's taxable income to you. So even though you got that $10,000 forgiven, you actually owe state tax as if that were income to you this year.
And if you're not able to pay the debt, all of a sudden they reduce the debt to zero, but the whole total amount that you've had forgiven becomes a taxable event.
Yeah.
Well, in the state of California, that could be as much as 10, 15%, not 15%, but over 10% of your total amount that was forgiven.
Yeah.
It kind of goes back to the short sale. I remember I had clients where they sold their home back in 2008 when the economy was just really crashing because of the real estate, and they had short sales. Well, the debt was forgiven. Well, they didn't realize the debt was forgiven, but they had to pay income tax on that amount of debt that was forgiven.
Yeah.
People were really surprised.
Yeah. And you think about what you might have to pay in a given year on your debt service.
Right.
Now all that's forgiven, hooray.
Right.
But if you now have as income, it's now on your tax bill. I don't know the numbers, how they would shake out, but you could potentially have to pay more in that year for the taxes than it would have been your periodic payment that was stretched over many years.
Yeah. So taxes are a big deal, and they may be boring. Most people say you're always going to end up paying. You can't escape taxes or
death. Right. Death
right?
and taxes.
But I think you do some planning, and what we try to do is help our clients be aware there's little idiosyncrasies in the law. There's certain things, and that's where we go through it. If we find something that is in the client's life that's just kind of an odd income situation, that's where we would go to the advisors that we work with, our CPAs and other, it depends on how deep it is. But we have clients that even have foreign income. And so
that's right.
You've got to deal with that, and you can't just shove it off and say, it's no big deal.
Right. And people who just don't deal with it until April.
Right.
You're locked in, you're stuck. And
right.
This is the moment to be strategic, to say, what do we want to do before the end of the year? So as we transition these two kind of fun items, but I want to talk a little bit about just the normal stuff. So the first one is kind of IRAs. If someone doesn't have a 401k through their job, they just have a regular IRA. This year it's $6,000. That's the 2022 limit. So
that's the maximum I can put in if I'm an IRA?
If you're my age and an IRA. if you're over 50, you can get up to 7,000.
Oh, you're trying to say the older people can put in more.
It's called a catch-up contribution. You can do a little bit more. So if someone hasn't had any contributions to any retirement, says, wow, I'm going to have too many taxes this year, they can take 6,000 or 7,000 if they're over 50, put it into an IRA and avoid taxes on the money. They get a tax deduction.
Right.
The next level up is 401ks. People who have a job and there's a 401k out there that they can contribute to. The limit is $20,500. Now, most people don't have money in the pot; they just throw it in there, and it has to come out of your paycheck. But people
let's kind of talk about the distinction between an IRA, because an IRA you could wait until April 15th or when you file your taxes.
Yeah, and you do one big, and that's a good comment. It's not December 31st; it's when you file your taxes.
Right.
So that April 15th, I'm not sure where it falls. I think it's 18th this year.
Yeah,
but you can actually contribute it to that in one lump sum. You can just do it.
But 401k is different. It can only get into the plan from payroll deduction. You can't wait until April and put money back in your 401k.
It's a December hard line. It has to be in December, and it has to come out of your paycheck. So we've had some clients who get to the end of the year and say, we're doing fine. We've got good money in the bank. We've had good savings, and I'd like to avoid some taxes and really boost my retirement. So they'll change their elections with their employer. They'll go to an employer and say, I'd like to put in as much as I can per paycheck for the next, say, 3 or 4 paychecks. We're in just about to go into November here. So most people probably have 4 paychecks left that they could put a large amount from those paychecks into their retirement.
And we've done that with clients. We've had clients who have received inheritance, and I looked at it, and their income was good, but they still needed the money, the cash flow from their salary. I said, listen, we'll take some money from your inheritance, which is tax-free. We can cross it over to you, but I want you to maximize your contributions to your 401k. Well, the husband and wife both working, they were putting almost 50 grand into their 401k, and they thought, well, we can never do that. But it reduced their overall tax liability, and we'll readjust on January of every year. But it was just a tax planning issue.
A good strategic move.
Yeah, exactly.
Yeah, that's a really good comment. If somebody had a windfall, a tax-free windfall for cash flow, that they could do that in a year. And so then next year, so $20,500 is what you can do. If you're a bit older, you can do $27,000 this year. Right. And next year,
it's a pretty big jump, isn't it?
Yeah, there's a benefit. $6,500 if you're over, I think 50 plus, you can put that extra in, those catch up, and you can do it each year. That's a big way to say, okay, I'm 50, I'm not ready for retirement, but I'm going to lean into this and really catch up.
So we've kind of discussed this with some clients who continue to work.
Yeah.
And past required minimum distribution age. Now the required minimum distribution age is 72. But if I continue to work and I earn a salary, am I required to take out my RMD, and can I still contribute
Yeah.
to my 401k, right?
It's an odd little moment. So if most people have worked multiple jobs in their life,
Right.
and when they worked a prior 401k, they've left that job and they age to get to 72, they have to start taking RMDs out of that account, whether it's a 401k account or the rollover IRA account. However, if they're still working for the job that they have the 401k with right now, and they get to age 72, if they're still working, they can delay their RMDs.
So again, it's a planning issue, because cash flow, some people will depend upon that to meet their cash flow. But most clients, when we're looking at delaying the distribution from their retirement plans, because they have other income. They have either investment income or they have a pension, and maybe they don't want that income because it is all 100% taxable.
Yeah.
There's no capital gains on this. There's no depreciation that you can offset this with. I mean, it comes out, and so a lot of clients going, I don't want the income.
Yeah.
And obviously most clients, we just have to say, sorry, this is the way the rules are.
Yeah.
You have
but if you're still working for that job, there's a little bit of a loophole there, which are things that most people wouldn't know unless you get in that situation.
Exactly.
And having a professional with you, that's the useful. So we talked about IRAs and 401ks. The other one to talk about is charitable contributions. I think most people are aware of this, that if you give charitably and you're itemizing your deductions, you'll get benefits for that tax-wise. And so as you get near the end of the year to think with your taxes, I always love to do for the accountant to do a pro forma tax picture to say, what does it kind of look like I'm going to pay?
Right.
And if I gave an extra, X amount of dollars charitably, what does that do for me? Is it useful? Does it lower me a tax bracket? One thing that people have been doing recently, because the standard deductions are so high, is in 1 year, a married couple say, we'll both take the standard deduction. So they get a nice reduction in their taxes. Don't do any charitable giving. Then the next year, they'll do 2 years worth of charitable giving.
They basically bundle.
They bundle, yeah. And they'll do all the itemizing. They'll give charitable giving. They'll do all the things they can to use their deductions if they exceed the standard deduction. And then the next year, they go back and take the standard deduction again. And because the standard deductions are so high, some people feel, well, I'm not going to get the credit for giving charitably. But if you bundle them into years, you can do that. So one thing to consider as you get to the end of the year is, do I want to give charitably? Would I do this anyways?
Right.
Do I want to do it before the end of the year? Or do I want to make a bundling year one way or the other? There's some good tax levers.
So the other thing too, if you're over, now this is kind of the catch here. Now, so if you're over 70, you can actually make a distribution directly to a charity in that year. So the year you turn 70. Now, a lot of people will get this confused with the RMD year because the IRS moved the schedule. So your RMDs are required at 72, the year you turn 72. But if you want to make money, if you want to make a contribution directly from your IRA, you can do that to help reduce your, again, I don't want to get too technical here, but on the front page, it helps to reduce your modified adjusted gross income. But that has an impact on potentially what you pay in Medicare premiums.
Right.
So bundling or taking the direct contribution or the distributions from your IRA or your qualified accounts going directly to the charity could have some other additional tax benefits to you. So
that's right. And some people aren't charitably minded, so this is not a concern for them. But a lot of folks that we work with, especially, are charitably minded, and they want to say, how do I maximize? I want to give. I want to support my community, but how do I do it in the most effective way? And that's some of these discussions, is how to do that. So we'll talk about HSAs in a moment. I think let's take a quick break. But HSAs, they are a great option for those that apply. So stay tuned. We'll come back right back.